Good morning again to everybody and welcome to the Central Bank of Trinidad and Tobago. Just give me a moment to just acknowledge the head table, Governor Hilaire, Dr. Alvin Hilaire, the Deputy Governor, Monetary Operations and Policy, Dr. Sandra Sukram, and the Senior Manager Operations, Mr. Alistair Noel, and of course to acknowledge you for coming and our public who they're actually viewing this live via our stream on the internet. So we are launching our MPR, the Monetary Policy Report for November 2016, and we have a simple program this morning, and we hope that we have lots of questions from you after the presentations. So the presentations will be in the order of Dr. Sukram, followed by Mr. Noel, and then by the Governor, and then we open the floor for questions. I should say Happy Christmas because we're in that season, and I think the next time I see you, I'll be saying Happy Carnival. So please welcome Dr. Sukram.
Good morning, everybody. I'm going to start off the presentation flow is as follows. I'm going to present on international domestic macroeconomic environments, and Alistair will present on the central bank's monetary policy actions. Okay, so we're starting first with the global growth. The IMF estimates that the global economy expanded by roughly 3.2% in 2015 and expect the world economy to grow by 3.1% in 2016. I must mention that this is slightly lower than its earlier estimate at the beginning of 2016. Growth in the emerging markets and developing economies is expected to increase to 4.2% and 4.6% in 2016 and 2017, respectively. Turning now to chart 2, we see the annual real GDP growth in the BRIC nations. I'll start first with China. The official data revealed that the Chinese economy grew by 6.7% in the third quarter of 2016, and this is low relative to their recent history. However, for 2016 as a whole, economic growth is poised to reach the government's target of 6.5% to 7%. Looking at India now, we see that India continues to be the world's fastest growing economy in 2016, growing by 7.1% in the second quarter of 2016. For Brazil, during this year, Brazil continued to grapple with an economic recession and political unease. In the second quarter of 2016, the Brazilian economy contracted for the 8th consecutive quarter, although by a softer 3.8% compared to a fall of 5.4% in the first 3 months of the year. Russia, weak energy prices as well as the imposition of economic sanctions, which depressed Russia's economy in 2015, continued in 2016. In the second quarter of 2016, the Russian economy contracted by 0.6%. And if you look at chart 3, just briefly, I'll mention that following a significant jump in the VIX volatility index due to the UK referendum in June 2016, volatility in financial markets generally subsided during the second half of 2016. So I'm going to talk a little bit about the policy rates and the inflation rates in selected advanced economies. After taking a first step towards monetary policy normalization in December 2015, concerns over the health of the global economy prompted the U.S. Fed to halt further policy increases in the first 10 months of 2016. The U.S. economy grew at an annualized rate of 2.9% in the third quarter of 2016, reaching the fastest pace in 2 years. The UK referendum on membership of the EU resulted in a vote to leave the organization, and this immediately generated negative market sentiment and expectations for the performance of the UK economy. However, economic growth in the United Kingdom accelerated to 2.3% in the third quarter due to strong growth in the services sector. However, despite the resilient economic growth, inflation still remains below the Bank of England's target inflation rate of 2%. The Bank of England also extended its monetary policy stimulus package by reducing its benchmark interest rates by 25 basis points to 0.25%. Despite the economic improvement in the euro area since the financial crisis, the medium-term outlook remains weak for the 19 bloc region. The European Central Bank maintained its key benchmark interest rates at 0% in October 2016, following a 50 basis points reduction in March 2016. The ECB continues to undershoot its 2% inflation target. In January 2016, the Bank of Japan became one of the first major monetary authorities to introduce negative interest rates, and it maintained its key policy rate in negative territory thus far in 2016. And deflation continues to loom over the Japanese economy as consumer prices declined by 5% in September 2016. Let us now look at the exchange rate and monetary policy adjustments in the BRIC nations. I'll start first with China, with the renminbi, China's currency, officially added to the basket of currencies comprising of the IMF special drawing rights. China expects increased demand for RMB-denominated assets from international institutional investors, with the corresponding capital flows contributing positively to exchange rate stability. In India, with inflation rate within the Reserve Bank of India's target range of 2 to 6%, the bank maintained its accommodative monetary policy stance. The RBI lowered its benchmark interest rate twice for a total decrease of 50 basis points in 2016. This move was aimed to further support growth amid weak private investment. In Brazil, reflecting optimism that their new president could trim the budget deficit and restore confidence in the flagging economy, the real appreciated by 2% between August and mid-October 2016. Gains on the inflation front in September allowed the Bank of Brazil to reduce its benchmark interest rates by 25 basis points to 14% in support of economic recovery. Finally, in Russia, the ruble has appreciated by approximately 13.1% over the first 3 quarters of 2016, and this is reflective of a slight pickup in energy prices. The Central Bank of Russia continued to support the economy by reducing its benchmark interest rates by 25 basis points to 10% in September, and this was the second reduction in 2016. Turning now to the region, and looking at some of the selected regional economies and some of their main economic indicators. In the Caribbean, economic performance has been varied in 2016. Tourism-dependent economies such as Barbados and the member states of the Eastern Caribbean Currency Union are projected to outperform commodity exporters such as Trinidad and Tobago, Suriname, and Belize. In September 2016, the IMF commended Jamaica on its excellent economic performance as the country met all the structural benchmarks. According to the IMF, the Jamaican economy is expected to grow by an estimated 1.5% in 2016, following sluggish performance in the previous 2 years. Over 2016 thus far, growth in the Barbadian economy will improve slightly. The Barbadian economy expanded by 1.3% in the first 6 months of 2016, following a strong winter tourist season. Following robust growth in 2015, Guyana's total output expanded by just 2% in the first half of 2016. And this was due to slower than expected expansion in major productive sectors. But the Bank of Guyana anticipates that the economy will grow by 4% over 2016, given the strong performance of the mining and services sector. Finally, for Suriname, the sharp decline in international commodity prices, combined with the closure of Suriname's Suralco alumina refinery in late 2015, pushed Suriname into a recession. Economic activity is expected to contract by 2% in 2016, following an estimated growth of 1% in 2015. And turning now to Trinidad and Tobago. An important factor in the Central Bank's Monetary Policy Committee's recent decisions has been the weak pace of economic activity. Provisional estimates from the Central Bank's Index of Real Quarterly Gross Domestic Product indicate that following an overall decline in growth of 1.8% in 2015, GDP is estimated to have fallen by 6.7% in the first half of 2016. Like most energy exporting economies, Trinidad and Tobago's weak economic performance in 2015 and mid-2016 has stemmed largely from the energy sector. In addition to the impact of declining rates of extraction from the oil and gas fields, energy sector output was curtailed on account of the temporary suspension of operations at two major oil companies. Indications are that the preparations at oil companies for incorporating new fields continue to affect output in the third quarter of 2016. A variety of available indicators also signal weakening in the non-energy sector during the first half of 2016 when compared to the year earlier period. Indicators of activities in the construction sector, such as local sales of cement, sales of ready-mix concrete, etc., all declined. And this can be partly linked to the slowdown in the execution of the government's capital program, including the road construction and housing development. In addition to the pullback by the public sector, the fall-off in business loans and real estate mortgage loans suggests that private sector investment may also be somewhat sedate. Let's look at inflation now. The first chart shows headline inflation. In the subdued economic climate, overall price pressures were contained between May to September 2016. According to the CSO's Index of Retail Prices, headline inflation on a year-on-year basis measured 3% in September 2016, and this is down from 3.5% in April 2016. Thus far in 2016, the inflationary pressures emanated from increases in the price of diesel fuel, the widening of the number of items subject to VAT, and the weakening of the TT dollar against the US dollar. Going forward, inflationary pressures may be mitigated by weakened domestic activity and the slackening of the labor market. Chart 2 shows core inflation. Core inflation maintained a stable trajectory over April to September 2016 on a year-on-year basis. Core inflation, which exclude food prices, measured 2.3% in September 2016 compared with 2.1% in April 2016. Food inflation, meanwhile, it slowed as there were no major reports of supply disruptions over the period. Turning now to the labor market. So labor market conditions. Official labor force statistics suggest that the labor market may be gradually weakening. The latest data from the CSO indicate that the rate of unemployment increased to 4.4% in the second quarter of 2016 from 3.8% in the previous quarter. In the first quarter of 2016, job losses occurred across several sectors of the economy. Additional information that we have at the central bank suggests that labor market conditions continue to adjust to the economic environment. Okay. Fiscal policy now. Central government's fiscal operations were noticeably constrained in fiscal year 2015-2016, mainly as a result of the low energy commodity price environment and the reduced levels of domestic energy sector output. With energy revenues expected to remain relatively flat in this financial year, the government sought to increase collections from the non-energy receipts. The budget for financial year 2016-17, that is this financial year, projects a deficit of $6 billion, which is 3.9% of GDP. The central government plans to finance the budgeted deficit through borrowing, of which 75% will be from domestic sources. The estimates show that total public sector debt will amount to about 60% of GDP in this financial year. It is hoped that the pickup in the public sector investment program to 5.1 billion may be growth enhancing. The non-energy revenues are expected to increase to 40.9 billion, of which 9.7 billion will come from one-off receipts. This is the partial sale of state-held assets of 5 corporations. If realized, this will lead to a further reduction in the non-energy fiscal deficit to 8.1% of GDP. The government aims to achieve a balanced budget by financial year 2019-20 and to limit public sector debt to no more than 65% of GDP. Finally, at least for me, chart 1 shows the gross official reserves. At the end of September 2016, the gross official reserves amounted to 9.8 billion, equivalent to 11 months of prospective imports of goods and non-factor services. The merchandise trade balance, which is in chart 2, Trinidad and Tobago's balance of payments continues to face significant challenges as the domestic energy sector adjusts to lower global commodity prices and domestic supply disruptions. The trade balance as a percent of GDP moved into negative territory in the first half of 2016 to 3.6% of GDP, from a surplus of 6.2% in the 6 months to June 2015. I'll now hand you over to Lister.
Today I'm going to just look at our, no, not just, but look at our monetary policy actions over the, given the context that Dr. Sukram would have outlaid there. First, let's look at our past experiences. We'd have seen that central bank, we have that role of trying to facilitate growth and limit price, that price pickup. Let's just go back to 2008. You'd have seen our key policy rate, the repo rate, which is the rate that we would charge commercial banks to provide liquidity to them. We kept lowering that because at that point in time, we felt that the growth concerns or economic concerns were more important than the price pressures. That was done until later part of 2004. And in 2004, while our GDP continued to slump, there were other emergent pressures that would come to bear, like developments in the international sector. At the end of 2015, we put a pause on our key policy rates. How has that worked? Well, if it is to influence market rates, one of the rates it influenced would have been the commercial bank's prime lending rate. And if you look at the slide on the chart on the right, you'd see that there's a very high correlation on our repo rate movements and the prime lending rates. Okay. One of the things we do to help the transmission into other markets would be manage the excess liquidity at from the commercial banks. Excess liquidity is defined as funds held at the central bank above and beyond the required amount. So that's basically idle resources. You'd see over the time we would have had some volatility. In 2016, we had peaks of 8 billion in excess reserves, and that would have gone down. And what influences domestic fiscal injections? And you'd have seen that for January to October 2016, you'd have close to 5.4 billion in fiscal injections, and also the banks would have used our normal open market operations to mop up liquidities, and also would have the capability of even issuing special deposits to treat with things like that. One of the things that what was outside the bank would have been some of the government actions with the financial system. So one of a major impact would have been the payment of resources from CLICO. It was sale of resources going back into government, and that would have mopped up some of the liquidity. So we can't only take benefit for our own actions, but there were other actions from the government would have helped normalize the excess liquidity to be around 3 billion for the last quarter or so. This slide just speaks to the makeup of our open market operations. So you would see that from the majority of our resources would be required reserves, which would be the blue. And then we would have our secondary reserve requirement, and also we have special deposit. What is trending here? It's just that over the times we would have had special intervention in the market using moral suasion, asking the banks to place deposits with us, special deposits. Over the last 3 or 4 quarters, that been coming down. We've been allowing them to mature because one, less fiscal injections, and we've been also using other methods to kind of keep liquidity down. So this slide just shows us that one, our excess reserves are coming down, bonds are maturing, and we didn't have to be so interventionist in management of the excess liquidity in the system. And the slide on the right speaks to the balances held. That is the quantum of securities the banks would have used to basically to manage liquidity. And you would see it's just hovering around under 30 billion of sterilized funds held at the central bank to manage our liquidity in the system. Remember, we talk about the impact of our policy on rates. One of the things that we measure, not only the prime rate, prime lending rate from the commercial banks, but would be rates that people can get on the capital market. And one would see that while we have kept our policy rate from basically the end of 2015 to present unchanged, we would have seen some upward pressures on capital market rates. So even while our rates on the shorter end have not changed that much, so therefore, like let's say for example the 3-month Treasury rate would have moved from 90 basis point to 0.9% to 1.2%. You'd have seen more movement basically on the longer term, and that is where it forces government, borrowing a little more would have put some pressures on those kind of things. One could also say us managing the having a better handle of excess liquidity would maybe you would get a lag effect of increases of previous periods. So in the 10-year case, in October 2015, our standardized yield curve would have suggested that this rate would have been 3.53%. It's now close to 4.4%. So therefore, you see the pickup in those kind of things. What does it mean to our major trading partners? One of the things we use to see how attractive investment opportunity and movement and influences in the movement of flows in and out of the country would be our USDT interest rate differential. When we look at the blues at the 3 months, when we look at a 3-month TT paper versus a USDT paper, you'd see that excuse me, from February 2014 to 2016, we've seen a pickup, and that's mainly because of increases in our domestic market. And one could say reasonable pickup because, but basically on the 10-year, it would have had forces from both ends. Yes, pick up on our 10-year paper, government paper, but also it would have gotten some movement, benefited from some movement on the U.S. end, where the yields would have been driven down because of volatility in the international markets. As you see, at the end, it's trending down now, and that would reflect some of the recent pickup in the 10-year yields on the U.S. end. Let's go on to another rate that the bank would hope would signal or guide from movement of our policy rates. On the blue line, that is our average loan rate, and you would have seen the average commercial bank loans would have come down, although we have seen a little pickup again in the latter part of in the last 6 months, hovering around 8%. But it seemed like we still have more work to do in influencing the weighted average deposit rate, which I'm told they have some movement there, but that line suggests very little, if so much. How did these things impact the credit growth? Still, we continue to see real estate buoyant, averaging around 8% over the period for 2015 to 2016. Total, however, total credit by the consolidated financial system, the growth it's adding at a slower pace. So we're looking closer now to little over 3%. And why is that? It's because one key component of it, you're actually seeing a contraction. So business credit is falling, worrying in a time when one would think that to get out of economic contraction, you would want your business to invest. Having said that, maybe they're just using their own resources and not relying so much on the banking system. However, we've also seen the consumer credit still continue at a lower rate, but still continue at a pace, and that may have a little problems later on. But having said that, our net non-performing loan ratios in the financial system, we have not seen any negative impact because of the credit from the consumer credit exposures to the banks. I want to just touch on the foreign exchange here. Dr. Sukram would have mentioned the performance of the energy sector. One of the greatest input or inflows into our foreign exchange system is the energy sector conversions. You would see that year on year we continue to see a fall off from 2015 to 2016, an obvious fall off, and that is mainly because of low conversions. We've also seen that there's a fall off in sale or conversions, sale to the public. In fact, if it is, we look at a similar period to last year, we would be at a stage of, let's say, selling 6.8, and this year we are closer to 4.8 at same period, similar period. What have central bank done? We've tried to support the market, but just recall last year was an extraordinary year. In fact, it was the highest we've had to support the market by. They had a couple of one-off transactions. One could recall in October 2015, where you were directed to sell $500 million to the system. So I'm not saying net that because that supported the system, but in a time where we have fallen reserves, the central bank continue to monitor, look at the prospects, and continue to support as we have the ability to. Not least, but I also want to just mention, as one can see from the slides on the right, the charts on the right, that we continue to have some flexibility on our exchange rate. In fact, I think today it's now selling at close to 6.79 to $1, which will be a little over 4.8% depreciation for the year, and with some depreciation, with support to the market, we continue to monitor the system. I would just kind of leave it here so the governor could continue with his presentation. Thank you.
Good morning. Thanks, Alistair and Sandra. Well, thank God it's Friday. I think, and so far it's a nice looking day. I thought the weather was supposed to be bad, but so we'll see how it goes. All right. What I wanted to do, if I could get this to work, is to chat, to put things in a large perspective, and chat on a few aspects of Trinidad and Tobago's global economic interactions. And why am I doing this? I remember a couple of weeks ago I was in Washington, and they were talking about all of the different global economic situations. The managing director was talking about Brexit, about global slump, about politics, and gave an assessment that the probability of a recession in Latin America was about 1 in 3, and in the rest of the world was about 50-50. I mean, this woke me up. I mean, I wasn't sleeping, but it woke me up. And so it's something I'm saying, well, are we really understanding what is happening globally, our role in this situation, and what the impact is for us? The second thing is that some time ago, I went to Jamaica, and I lost my luggage in the flight. And I ended up in a long conversation with the immigration officer. And what were we talking about? Trinidad. This guy was knowledgeable about Trinidad, about what the politics, about the scandals, about the economics, about the budget, and so forth. And you realize that, wait, this is not just curiosity, but this is self-interest, because a lot of the Caribbean countries depend on us. So the upshot of it is that we have a place in the world that we are in, and that a lot of things are affecting us. Some of the things are more obvious, like energy prices and a recession in the US or whatever, but other things may be more subtle. The immigration or emigration issues in Europe, the use of the Chinese currency in the SDR for global finance and so forth. A lot of issues, and also what happens here, policies here, and the fortunes of our economy affect the other Caribbean countries. So this is why I thought, let me spend some time on looking at 5 aspects of our interrelations with the rest of the world. And the first would be dependence on commodity cycles. The second, on financial interconnections. The third, interest parity and capital movements, what happens in that area. Then a little blurb on the outlook for emerging markets, and a very interesting topic on labor mobility, remittances, and what some of the implications for us and our policies. So by way of background, it is clear that Trinidad and Tobago is deeply already embedded in world affairs. As I was saying, we have a lot of these, you see these things jumping out like that. Some of the things. The most recent one we had to put in the US elections, the Brexit, which could impact on tourism, services, remittances, and exports. Chinese, what happens in China affects the steel industry because of the demand. The Caribbean growth impact the demand for our exports and so forth, particularly in the non-energy side. Latin American slowdown of natural gas output and production and exports. US interest rates, and we'll talk a bit more about that. So a lot of things are happening, and we are a small country. We're just 1.3 million people at last count. We have a very small land area. I mean, and our population is, I used to work in Colombia, and in Bogota is about 6 times or 7 times the population of Trinidad and Tobago. So you see how tiny we are. But we are important. We consider ourselves important, but we are also important in the sense that we have a high per capita GDP. I'll get into that shortly. We have influence in world affairs, and we also affect the other countries around us. For example, on the second slide, I think we could get that to spin around, not so much an exact circle, but we are an important trading partner in CARICOM. We are a major supplier of ammonia and methanol. We have significant financial links within the Caribbean. Foreign direct investment is a big part of the story. And then we are a member of the, among other things, a lot of international groupings, such as the Group of 24. So if you were to look at this chart, you would see that when you stack up all the IMF countries, although we are tiny, we are 41st in the lineup of per capita GDP at around 16,000 US. I mean, it varies depending on the exchange rates and all this sort of thing, but around 16,000 US. So we are, in a sense, punching above our weight if you would just look at size and population and so forth. In fact, we are a member of the Group of 24. If you look at the corner, you'll see me somewhere. You could hardly make it out. But the Group of 24 is a very influential body that represents the positions in monetary and financial and development issues at the World Bank and at the IMF. We happen to be a founding member. We are the only Caribbean country. We are the smallest country, and we are one of just a few in Latin America. In fact, there's debate now about increasing the size to accommodate more developing countries, because you have a lot of them want to make sure that their views are heard. For example, Morocco is not a formal member, but they participate as an observer, and they want to get their views heard. So we are influential. So the fact is that the background is such that we have to notice that things affect us. One, we are small, but we have a lot of weight. We have multinational companies working here. We have a sophisticated infrastructure. We have GDP that is high, and we have influence in world affairs. So let me go directly into some of the issues. The first one, as I mentioned, was the commodity dependence. In other words, the clearest expression and the most obvious one is that we are an oil exporter, latterly because previously it was sugar, cocoa, and so forth. But we have oil, we are blessed with natural resources. We export oil, we export natural gas, and natural gas-based products. And so everyone knows about Dutch disease, knows about all these different things, and our reliance on the commodity cycle. And just to give the flavor of it, you would know that the bulk of our balance of payments, GDP, government revenue, a lot of it is dependent on the energy sector. So these are things that you would know already. So just a few numbers. Between 2000 and 2015, energy exports accounted for about 83% of export values, and the energy sector taxes made up about 39% of fiscal income. So this is quite important. We have a situation where we have, we are dependent on the fortunes of an externally determined price or prices, which is on the energy side. And this is quite important to know, of course, because when these prices go up, we tend to be moving to the rhythm of them. So our boom-bust cycles in Trinidad and Tobago tend to be related to that. Of course, there have been attempts to what you call smooth the path or smooth consumption over time by saving during windfall years and then maybe able to spend it when times are difficult. But to a large extent, we have been running to the rhythm of this external situation. Now, and providing the backdrop of some of what was said before, we know that we have had a major problem in our export values. And the starkest example, if you look at oil prices between 2008, around $100, and we were saying, well, this is normal. Now we getting into the late 40s, early 40s, so things are quite different to before. One of the important things that we all are aware of, unlike some other countries which have had to react immediately and adjust everything directly, because of a situation where we started off with some significant buffers, one, fiscal space due to years of surpluses before, and a relatively low public debt. Then we have international reserves about close to, at the starting point, about a year's worth of import cover, savings in a heritage and stabilization fund of about half of that amount. These are significant things to start off with. So it meant that we were able to, in a sense, not have the immediate drastic adjustment as would have been necessary if we did not have that. So we start off with something in our favor. But here is where the fairly chilling part comes in, and this is an important statement, that there's a real possibility that energy price movements could reflect secular as opposed to cyclical trends. And what do I mean? In general, oil price movements have been somewhat characterized as if they were a normal commodity. In other words, the commodities are subject to regular up and down cycles because of a combination of demand changes, which may be due to some issue in a region, a country, or the globe that either bumps up or reduces demand, or supply conditions because let's say there's overproduction, there is a drought. I'm talking about in the case of food production, or there is abundant harvest or locusts or whatever. And then you have with the juxtaposition, or suppliers may decide, let's put things a certain way, let's form a cartel, let's do things. So this combination of demand and supply together may lead to regular cyclical movements. But as I said, the chilling thing, and here we have to be very careful in terms of our understanding of what is happening and our policy response to it, is that we could be seeing something that is secular. In other words, that it is something that persists as opposed to a regular cycle. If you look at the chart on the left, you would see the oscillating pattern of oil prices. We all know when oil prices went up and then they went down, and then we were rescued because they went back up and they went. So the question is, could we expect that it will go back up? Well, not so sure. If you look at the chart on the right, you would see the projections. This is from the IMF World Economic Outlook. And if you can see that the little red line shows that the price that is anticipated is expected to be fairly flat. So this does not suggest that there may be a big recovery. Of course, all the blue lines and so that the possibilities, and of course it could be much higher, it could be lower, and so forth. But generally, the central projection is that it be fairly flat. And if you look at the latest, just a couple of days ago, the OPEC released their world oil output report, and their projection now is by 2020, their reference basket price would be just about going up from about $45 to maximum $60. This is down from $80 when they had it just last year. So there is a feeling that we could be in for something that is long term, and I think this is significant. For example, and behind this, the long-term energy issues include on the oil as well as the natural gas side, the advent of shale oil and gas in North America and elsewhere. The OPEC actions to increase oil production. Some members want to increase production because they've determined that, listen, they need to get the revenue when it's there. You have lower demand growth in emerging markets. You have the situation of nuclear power in Japan that's coming up more to the fore. So what you could have is and also we haven't even talked about the discoveries of major natural gas fields in developing countries. So the upshot of this first point, which is on the commodity cycle, is that we remain dependent, but this could be different to previous episodes because we could be in it for the long term. And what this would mean is that policymakers, everyone in the society would have to consider that we may need to re-engineer the entire economy, not just deal with short-term balance of payments difficulties and, getting forex here and there and, balancing the budget each year and so, but a fundamental re-engineering of our economy to a situation where oil prices are at a fairly, well, subdued level. And this could take a lot of thinking. The second point is our financial system being closely linked to world markets. As we know, we have international banks, we have indigenous banks, we have a range of other financial institutions, but they're all very closely integrated with the rest of the world. We have branches, subsidiaries, headquarters, you name it, in North America, Latin America, India, Asia, all around the world. So already you have that in the banking system, you have it in the insurance side, then you have a combination of banks with insurance companies, with other entities. You have conglomerates that include different services in addition to different financial services, but also other products. So the whole thing is very integrated among financial institutions, but also across the region and across the world. So we are part of this complex hub. So this interesting picture, which if you could remember it, you get a prize. But you have some of the major institutions or financial institutions, and you see just how the links with other countries and regions in the world. What does this mean? Of course, it means, well, two important points. One is that it does spread the risk somewhat, but of course it does increase the ability or the capacity or the probability of having what you call contagion or some impact of some external event on your financial system. So it's a two-way thing. It spreads risk to some extent, but it also means that what happens elsewhere could affect you. So it's something that needs to be taken into account. The other clear aspect, and it's important for the central bank supervisory people, is that when you are trying to supervise or manage a financial institution, you need to know what is happening in the other countries that it deals with. So there needs to be a lot of cooperation among regulators and supervisors. And a lot of this is already happening to prevent what you call regulatory arbitrage, that institutions would go to the areas with the lowest regulation, but also to make sure that there's a clear understanding of what is happening in the region. So we have a lot of the Caribbean group of banking supervisors. You have associations and insurance. You have on securities and so forth that all get together and discuss these things in real time. I mean, our financial institutions people are always traveling around the place, dealing with these interesting issues. So we have the contagion, we have the supervisory aspect. Let me go on to an issue that is quite topical in today's world over the last few years, and this is one involving de-risking, and you may have heard about it. And just to simplify it, it involves the loss of correspondent banking relationships. I'm using it in this sense. Between, let's say, a local bank and its foreign counterpart. Why do you need a foreign counterpart? Because to enter, let's say, the larger countries, for if you had to send remittances or you have to send money or whatever, any financial transaction, you have to have a presence in that particular country. So this is where you have the big banks having relations with the banks in other countries. So over time, and particularly recently, there has been a loss of this thing. The reasons are myriad. Part of it is due to a greater push among international agencies and countries to clamp down on money laundering activities, terrorism financing, and so forth, so that the regulations have gotten tighter. The second aspect is that the banks themselves, the large banks themselves, they have been revisiting their operations and saying, listen, does it make sense for me to invest in a relationship with a small country's bank when I may be hit by the regulator, with a big fine or something. And the combination of all these things has led to a withdrawal of some of these. But although it is a private sector, and you would say, well, what's the big deal? They could find other institutions, but sometimes it's not that easy. The consequences are also very, very dire, and a lot of it would be unintended. So even, let's say, a tourism, someone is selling, I think the Jamaican finance minister talked about that in Washington. Yes, selling some goods, to tourists, someone is selling and they get the foreign exchange. What do they do with it? They have to, at some point they might want to send it somewhere. They can't go to the banking system. So a lot of things could be affected. And so the remittances, the movement of funds from one country to the other, the purchase of goods, the purchase of services, sending funds to your children abroad to study, a lot of these things could be affected by this this situation. And it could actually lead to a paradoxical or ironic outcome where, because of attempts to curtail terrorism financing or to improve anti-money laundering controls, by cutting off these relationships, it may drive activity into unregulated areas, and people use more cash and they go through shadow banks, and so a lot of it is it is a large, major issue, and I mean, I've been in recently just in last month and a half to 3 conferences dealing with that. One was at the IMF World Bank meeting in DC. Then the other one was in Antigua just a couple of weeks ago, hosted by the Prime Minister of that country. And then the third one was last week at an IMF forum here. So it is a live issue, and when we were in Washington, we actually met with the Secretary of the Treasury to discuss these things and so. What are the solutions? The solutions include improved compliance among institutions to make sure that they handle their anti-money laundering controls and all of that well, but also to make sure that the expectations of the regulators are well documented, understood, and people don't go overboard. It sounds simple, but this is the core of it. As I said, work is advancing in that area. Well, let's get down to Trinidad and Tobago now. What does it mean for us? So far, partly because of our deep links and international connections with international banks and so forth, we have not so far been hard hit by this compared to, let's say, Belize and other countries where it is very, very, very dire and they are on the edge. But we have to also, it's important to establish the framework for this activity. For example, the issue of FATCA, the FATF, the mutual evaluations, and all these things need to be sorted out so that the overall framework is established of compliance with either taxes, in the case of FATCA, or anti-money laundering, terrorism financing issues in the case of the FATF. And there would be evaluations coming up. And I think this is important to establish. And the point is that I mentioned in the solutions compliance, but compliance must be at different levels. It is not sufficient for, let's say, the individual institutions to comply with these conditions, but the overall jurisdiction is felt to be, lax in compliance and so forth. It is not impossible, but I think we need to have some focused effort to get that sorted out. And we also need to work with our Caribbean and other countries to keep this item on the agenda and to have solutions that are meaningful, because to the extent that it affects them, then it affects us, because then fragility in their banking or other systems could spill over to our country. So that was the second point. let me go to the one on the third point on interest parity considerations are crucial. You'll have some fun with this one because you have a nice equation here which I'll ask you to solve in 3 minutes. But so it's a whole seemingly complicated equation which really relates the forward exchange rate and the spot exchange rate, the differential to the difference between local interest rates and foreign interest rates. So before you leave the room, let me explain it and break it down and make it not so complex. What it really is saying is that there is a relationship between rates in a, especially if you have an open capital account and transactions could move, financial transactions could move easily, between the local rate and the foreign rate. Alistair had talked about interest differentials between the exchange rate or exchange rate expectations. If you have forward markets, that could help. Capital movements and macroeconomic policy credibility. So let me get it even more concrete, because you would really be upset with me. So what does it mean? It means that monetary policy must be sensitive to external interest rates and risk factors. As was discussed before, monetary policy, and in most countries, goes through one of the instruments is the interest rates. And if you look at the chart, the first one is the US 3-month differential. You know, as the rate, our local rates compared to the foreign rates. The other one is, the green one is the 10-year differential. And then this other one is the repo rate. And it is clear, and Alistair, I think, explained it very precisely, that in our, if you look, the red one, we have been taking into account foreign rates in the setting of our local rates. Why? Because to the extent that capital could move, it would move to areas where the going is the best. And one measure of that, or the most, well, the one that is announced would be the interest rates. So you look at interest rates high in one place, say, well, I'll put my money there. Interest rates low, I'll take my money out. So your capital moves. Over time, of course, the movement of capital could tend to bring rates in line, because, you know, they go to where things are highest and so forth. But apart from that, there are other things. People would say, well, I'm investing, but I'm investing in the currency of the country. So I have to take into account the exchange rate. Because when I change it back, I would be getting that foreign currency, then I have to put it back in my currency, etc. The upshot of it is that exchange rates matter. And here is where, in our situation, if I go back to the point about the capital movements and the macroeconomic policy credibility, it is not only important for the central bank policy on interest rates and whatever to be sensible, but there must be also a cohesion of macroeconomic policies. Otherwise, people would not believe what is happening, one. It probably won't work. And then they would be making the assessment of risk based on that. And so therefore, all of this complicated story means that you need to take into account everything. So to summarize, then, not only how monetary policy is conducted, but the comprehensiveness and consistency of the overall macroeconomic adjustment program. As I noted earlier, the terms of trade shock that we have was large. What are the other aspects? We have the monetary policy, yes, but we have fiscal policy. So the government had announced over time, since a couple of years ago, different budgets based on different oil price and other assumptions. Most recently, we had one last year, September, then we had a revision in April, then we have one just a couple of weeks ago. And all of this is part of the fiscal path. So everything needs to hang together. As I'm sure we'll discuss later, we do have some disequilibria in the foreign exchange market, and I think as things settle down, as the whole fiscal path and everything is coordinated, if this is done well, then this could help to smooth the way to an economy less reliant on energy exports, and certainly in the short run to get things sorted out. So let me go quickly into the last 2 points. The fourth point was on the economic outlook, because we fit into that. As I said, I was at the fund, and you see all of this interesting stuff. And you could look at your leisure. You see by the way, you'll have the slides on the website by I think 11:30. Correct. By 11:30. So in a little while, you could get it on your phone or whatever, and as well as the text of what I'm talking about. But you see although you have some growth in developing economies and market and emerging markets predicted, it is not stellar certainly compared to before. And then the last one is interesting, the probability of recession in Latin America being about 30-something percent. It's down from the April projection of the IMF, which was about 60%, which is quite high. But the rest of the world is still steady around 50%. So this is not very encouraging news. You have to be careful. And I think the IMF chief economist summarized it quite neatly, if not very cheerfully, by saying that the world economy is moving sideways, so that things are really complicated. And some of the things that they were citing at the time included the response to Brexit and the implications for trade and institutional relations between the UK and Europe, China's short-term economic prospects. There was some firming of non-energy commodity prices, so this would have affected positively the non-energy commodity exporters. And the risk of subdued growth leading to anti-integration policies gaining more traction in the advanced economies. So an interesting one. And moreover, the daunting policy challenges faced by emerging market and developing economies in adjusting to weaker commodity prices. And as I said, the probability of recession was, in my estimation, very high. So I think a fair summary of what he was saying and the whole of the fund was saying is that in terms of policy implications for developing and emerging markets, they should really spend some time, do the proper policies to build resilience to deal with a very complicated external environment. As I said, talking about my colleague immigration officer from Jamaica, it's a two-way street. And our issues, although we may have our problems on the macro side, it affects our neighbors. And you could look at this when you have the time. You would see the comparative situation. And this is for consistency, we use the information a lot from the World Economic Outlook database, supplemented by Central Bank of Trinidad and Tobago, Ministry of Finance, CSO, etc. So you could, you have the sources there. But the overall picture is that we have our difficulties, but other countries, particularly on the debt side, the fiscal balance, and so forth, they are in a deeper hole, as it were. So a lot of support may need to be extended. We haven't even talked about our neighbor Venezuela yet, but that I'll come to that in a second. So what does it mean for the Caribbean? We have been able to provide financial support to the Caribbean over the years. They had a petroleum fund, they had CARICOM, multilateral clearing facility. We were able to contribute as a net contributor always to the CARICOM Development Fund. But our fiscal issues now may constrain some of that. I think we would still make the effort, but it will constrain that. So the other countries would have to be alive to that possibility. But you have other things going on in the background. As I said, it's a macroeconomic situation and everything is connected. For example, the energy subsidies that we provide, they give sometimes, people say it's an unfair advantage to Trinidad manufacturers, but it is something that people are aware of, and manufacturers, you talk to the Jamaican manufacturers, the Bajan manufacturers, they would say, listen, this is, this is unfair. But if we have to adjust our situation, then it means that this would be affecting the competitiveness of our manufacturers, etc. So energy subsidies, policies to reduce energy subsidies would lower the comparative advantage of locating plants in Trinidad and Tobago, etc. So ultimately, the linkages with other Caribbean countries are so tight that domestic economic measures can have regional impacts and eventually feed back onto Trinidad and Tobago itself. Let me go into the last point on migration issues. A concrete expression of uneven economic opportunities across countries is clearly the incentive to relocate. We don't have that recent economic statistics, but the 2011 statistics show that immigrants to Trinidad and Tobago numbered just under 50,000, most originating from the Caribbean, and on emigration, mainly to North America and the United Kingdom. We all know about that. At the same time, and a very fascinating point is that you would be hearing over the last couple of years that businessmen have been complaining, although we've had economic difficulties and we know the unemployment numbers, of gaps in the labor force and who they could hire. One at the very high level, specialists, skilled specialists on some fields, and then at the very, very less skilled levels. And so this is a very interesting phenomenon with low skill and education. And what that has tended to do is to encourage nationals from other Caribbean countries or other countries in general to come to fill these vacancies. And it is something that needs to be taken into account in the design of public policies. And of course, we have some major construction projects encouraging the inflow of Chinese workers, difficulties in Venezuela leading to some people coming to our shores for, etc. And one of the things that you would find is that the remittance flows have been telling the story. So if you look the green, what do you call that, pin? The green pin is where the remittances tend to come from. So UK, North America, etc. And the red ones where they tend to go. And we see the Caribbean, some in clearly to families in the US. Then we have Venezuela, we have some other Caribbean countries, Guyana, etc. And then we also see China on the right side. What you see is that when you look at the numbers, the remittances, so these are the remittances inflows. It's going steadily over there in US, millions of dollars. And if you look at the outflows figure, you see they actually crossed in 2014. So that by now, we are a net provider of remittances to the rest of the world in the order of, in 2015, according to our estimates on the private side, about 43 million. So there's something that needs to be taken into account. So let me just go, or before I, just to wrap up the story on the immigration, it's we have to be taken it very much into account. Now, immigration could be a large issue, and we know what's happening in Europe. We know that it's a a very complex situation, and it actually spills over into a number of spheres. For example, humanitarian, cultural, ethnic, security, and other issues. It is a thing. I'm not saying that this is where we are at in Trinidad and Tobago or where we will be, but certainly on the economic front, some of the things we need to be aware of and the consequences of migration relate to wage rates in the relevant sector, employment conditions of migrants relative to locals, the provision of social and other benefits to migrants, the portability of national security, pension and other benefits, and taxation of migrants. So, and then overall now, in essence, then these consequences must be taken into account in the design and implementation of policies that impinge on the attractiveness of Trinidad and Tobago for migrants, including public sector employment programs that draw workers out of other low-skilled jobs. Because if they draw workers out of there, then somebody fills it in. So these things need to be taken into account. All right, so I've talked a long time. Let me just wrap up quickly. What does it all mean, and what do we do with all of this? First of all, data and intelligence and Trinidad and Tobago's interaction with the rest of the world is critical. For public and private decision makers to really do a good job, they need to understand what is going on. And you need detailed, real-time statistics on energy markets, financial indicators, market sentiments, development and prospects in other economies, migration, and so forth. These must be constantly on hand. They are around, but they are somewhat scattered. I remember we had a visit just, I think, last week from an ambassador, and he was saying, listen, some investors from his countries want to come and invest, but they're looking for the numbers, but they can't find it. They get something for a year ago, and they have to ferret it out here and there. We need to put things together to make this organized, and not just the data alone, but the intelligence. What does it mean? And to coordinate that. So a longer-term collaborative endeavor to improve collection, the technical basis for the statistics, and the dissemination of relevant data and market intelligence must be a priority. And finally, domestic policies must formally integrate feedback effects from external reactions. In other words, what I've discussed is a very layered, complicated, and interwoven position of Trinidad and Tobago in the world, with the migration, with the G24, with the other Caribbean countries, and all financial interconnectedness. But when policies are designed, we have to understand them, take it into account, and see the implications that may come back to haunt us. So we hit the domino this way, but you have to watch it, because at some point you have to get out of the way. So, and then finally, a strengthening of coordination among technicians, public policymakers, and private sector agents would also help to accelerate the extension of Trinidad and Tobago's influence in economic matters and our contributions at the regional and world levels. So thanks. I'll just leave it for there, and we'll look forward to questions.
Thank you, Governor, Sandra, and Alistair. Just a couple of things as you think about your questions. The graphics. I really hope you appreciate that we are trying to make the graphics more interesting and more exciting. It's just part of the overall communication strategy. So I hope you've noticed that. We have packages for you when you're leaving, but yes, it's going to be on the website so that you can feel free to go. All of the presentations we did will be on the website. In fact, they probably already are, or just about to be uploaded. And I just want to take a moment to thank all the staff, all the departments who worked diligently to put this together. We truly appreciate you and what you have done. So let me just open the floor. Don't all rush. And you go to the microphone, just say your name, ask your question, and we'll be happy to respond.
Governor, you spoke about the re-engineering of the...
You don't have to ask me all the questions. Go ahead.
Yeah, you spoke about the re-engineering of the economy to adjust to the secular decline in energy prices. Um, what form do you see that re-engineering taking place? And secondly, there was a reference to, believe it's $2.6 billion coming from CLICO to the government, contributing to change in liquidity. The central bank has not said anything for quite a long time on the CLICO resolution. Could you please rectify that situation today? Thanks.
As I said, the re-engineering would require a major long-term effort. I think everyone needs to be part of the game. We have the three aspects of policy, which would be fiscal policy, monetary policy, then we have structural policy. I think apart from fiscal policy, just trying to equilibrate the budget and to keep the debt at manageable levels and so forth, there needs to be a concerted effort to improve the revenue sources and to get away from the reliance on energy. Apart from that, structural issues matter. The way of doing business, the efficiency of the economy needs to be really shored up, because we are getting into a world where, as the government needs necessarily to roll back its activity, then the private sector needs to take a bigger place. So the private sector also has to step up. So all in all, first of all, there needs to be recognition of the situation. In the short run, the policies must be designed in a way that is calm, confident, and with the appropriate communication. But over time, you need to have all actors playing a part, because if we think about, let's say, 10 years from now, when we don't have that much oil production, energy production, we'd be thinking differently. We'd be looking at a society that has to depend more on other services, that has to be sharper, and that has to deal with all the different challenges. So I think it's really a combination of everyone working together. I wouldn't want to say specific sectors, because these would come up depending on the interest and so forth, but this is how it needs to happen. The short-term stabilization, yes, but the long-term re-engineering, and we need to be sharper in all areas. We can't tolerate a lot of waste here and there. In terms of the CLICO thing, I think a lot of things have been going on the CLICO side, as you would be aware of. The resolution plan was adjusted in July with the agreement of the ministry to allow for repayment of remaining non-connected, non-governmental STIPs and mutual fund policyholders. We had the 2.6 billion. This actually increased to 3.1 billion that was paid to the government. So the other items in the resolution plan are continuing. In terms of the sale of the traditional portfolio, and to be fair, if you look on the court, there is a regular quarterly update that is provided to the court. So when you look at that, you would see what is the latest summary of things. In terms of the sale of the traditional portfolio, the sales process of offering the portfolio to interested buyers has been completed, and we are currently in the process of assessing the responses received, and we'll be able to come to a decision shortly on the best way forward. So these are the major things going on. The legal matters tend to complicate things a bit, but I think things are moving, and we have intense collaboration with the Ministry of Finance to get things sorted out. The CLICO matter is an important one in our history. Certainly, as Nicole mentioned, in the central bank, we are looking at it in different phases. One is to understand what happened and to be able to learn the lessons from the CLICO problem, and to be able to resolve it as soon as possible to get all of the things nailed down, but also to learn the lessons to help us improve our surveillance and supervision in the future. And a big part of it would be the legislative framework. So you would recall that at the last financial stability report, we had a discussion on the imperatives of moving forward on the insurance bill to get the framework established. So we will be pushing as far as possible to get that sorted out. So apart from resolution 1, understanding the issue 2, but shoring up our capability in the context of a revised framework would be also important.
Something of a follow-up question, Governor, to your business of re-engineering, transformation, another word to call it. And in light of what you've identified as the secular movement of prices, energy prices, over a long period of time, we can hope for some magic to happen now. Based on a couple things in your document, one of them, the direction of credit through credit cards and other forms of credit, they're going to consumption in the main, and the purchase and utilization of foreign exchange. Once again, I think my small calculation of your figures is something like 54% again to consumption, 13% to manufacturing. Must be a real cause for concerns here as to this re-engineering and transformation of the economy that has to happen. And I'm wondering if, in addition to the items that you've talked about with regard to re-engineering, if you are perceiving long-term transformational requirements. You know, back in the early 1980s, again after a period of oil prices crashing, the local manufacturing sector really came forward and kept us going for a long time, certainly within CARICOM. What do we have to do really is the question. Do we have to start from kindergarten to start transforming minds? Don't just simply teach people to remember information that we know already, and generations have known A for apple and B for bat and so on. And right up to the tertiary level, especially at the postgraduate level, where we start to produce some innovative minds. Because, you know, so the question to you is, where do we go from here in a long-term kind of way? The Deputy Governor talked about the local sector in a very nicely coded diplomatic phrase when she said something like somewhat sedate movement. We need to get out of the sedate mode into something else. How is the question?
All right, well, thanks for that question. Let me see which one. Long-term transformation. I firmly believe that that is the juncture that we are in, that we need to really start to think differently about our economy and how we do things. I don't think we have to start from kindergarten. This is my personal view. I don't think we haven't discussed it with the staff of the bank, so they might distance themselves. But my personal view is that we have a lot within us as Trinidadians and Tobagonians. I remember we had recently the Eric Williams Memorial Lecture, and the speaker, Sir Hilary Beckles, talked about how he viewed Trinidad and Tobago as basically the intellectual powerhouse, and that we would not follow tradition. We are very creative. We would do things in a certain way. And it was fascinating because, you know, he's from Barbados, so it was like, I wonder if he get in trouble with his people for saying these kind of things. But when you think about it, and when you look at the issue that I was talking about, how we punch above our weight, I think we have a lot within us. We have a lot of creativity. We are well tapped in. We go everywhere around the world and we excel. And so we have it within us. Now, of course, human nature is such that sometimes when you have a lot of resources, you kind of relax a bit. So perhaps now that we may not have that much resources, then our latent possibilities may come to the fore. But I am very optimistic. I think we have it within us. We have the buffers, as I said, for a while, so we don't have to rush to do things. But we can't blow it. We have to make sure that we think very carefully, we organize ourselves, we think strategically, and I think we could do it. But I do think it would be, when we think, let's say, how our economy will be in 10, 15 years, we'd say, well, listen, this thing may be shaping up differently, and in a world with fast communication now, as you could imagine, in a few years, and more integration, we can't waste time. We have to get things moving very quickly, and to be able to take our place in the new world. There was, I think you asked about a,
Secular movement of energy prices.
well, I think that was related. The credit, I'm not sure if that was a question on the credit. Oh, just using that as
Where it's going to.
yeah, I think just
Consumer
as
driven,
yeah, just as you mentioned, and Alison may jump in on that. We have noticed that the credit numbers are skewed in terms of the growth towards the consumption as opposed to business, and I think this is a sign. And as Alistair said, we're not sure if part of it may be using own resources. I think the liquidity is there, but it may be a demand issue that because of uncertainty, you may have some reluctance to leverage more, and so this may be holding back business credit. I think.
I just have 3 questions. Governor, what are your expectations for 2017? Do you expect the slowdown to continue? Also, companies are already saying that the foreign exchange problem is affecting their bottom line. Do you expect this challenge to get worse come 2017? And how are you managing the sale of forex from the central bank side and maintaining the country's foreign reserves?
I think you asked all the questions to me, so I'll answer. Let me start with the prognosis. Our prognosis initially was 2-point-something% negative in this year. We haven't revised it formally. The numbers so far, although sedatingly presented, but they're still somewhat chilling about energy output and so forth, suggest that there could be a risk even to that happening. But let's see what happens for 2016. 2017, we do expect a resumption, even if it's because you're at a low base then. So we expect some pickup in energy production. On the non-energy side, a lot would depend on what happens on the fiscal front, in particular if there is fiscal contraction. When we looked at the numbers on the government capital expenditure, it's not something very encouraging in the sense that part of the fiscal constraint has meant in the short run that capital expenditure has actually slipped a bit to the extent of about just over 3% of GDP. And we think this is not something that should be sustainable. You should really have more capital expenditure. But in the constraints, choices need to be made, and I think that's the short run one that has occurred, certainly last year. But we do think there would be a resumption of growth next year of order maybe at least 1.5% or so. But by our January report, economic bulletin, we should have firmer numbers on this year and then next year. But certainly on the energy side, from the reports we've been getting, that energy should pick up a bit, even if it's just partly statistical, because it's gone to such a level that you would find you're recording growth based on a low base. On the forex situation, there's a very interesting subject. We do recognize there is an imbalance in the foreign exchange market. at present. We meet with the traders regularly. We meet with the commercial banks, insurance companies, and so forth. So we have a pretty good handle on the situation. And although you didn't ask it, let me elaborate on a little bit of it. That, and as I said when we had chatted last 6 months, and the situation or the policy is more or less the same. The imbalance in the foreign exchange market represents, or let me start up even further back. We are in the early stages of a major economic adjustment program. Economic adjustment. The foreign exchange market is symptomatic of that. And as we had discussed before, because of the rapidity of flows of foreign exchange and so forth, it has come out in the imbalance. So we know there's an imbalance. For the whole thing to come together, you need to have, as I was saying before, policies that are coordinated. You have a fiscal program that is still in the course of development. We had the September budget, you had the April 8th review, you have the new one that has just been announced that has certain elements to it. And we think that and we think this is a very good start in what may be a long process, potentially, depending on what happens with energy prices and so forth. So we think that as things come together, the imbalances will be sorted out. All right, but in the short run, we think you might actually have some worsening of the situation based on the seasonal demand, Christmas and all this kind of thing. So we would not be surprised to see a worsening or tightening of conditions over the next month or so. We believe that over the first half of next year, however, things should settle down as everything comes together, and that the situation in the foreign exchange market could be alleviated over that time. But we are, as I said, putting it in a broad context. We are not talking about just small, a temporary imbalance that is related to, some mechanical thing in the system. It's a major adjustment that the country is going through, and this is part of the story. So I think this relates to the question about the short term and the longer term. There was a question, the sale of what is that? Or how do we? How do we? Our role. Yes. The central bank role.
Would you reduce reserves?
Right. So just to add to what was said before, what is the central bank's policy in this framework? Our position is clear that in a context where we have this major thing to deal with, this major economic reform and so forth, and the foreign exchange market being the first mover, we continue our policy remains consistent, that we do not target a level of the exchange rate. We try to minimize volatility, so wild swings in the exchange rate. We try to also improve or to foster credibility or consistency in our communication and policy. We intervene on every 2 weeks. I think last time it was 75 million. I think we'll probably be selling another 75 million by Monday or something like that. What do we look at? We look at, in determining the amount, we look certainly at all the indicators on the inflows and outflows of foreign currency in the short run, what is behind it, and so forth. We listen to market sentiment. We also look at the long term. We look at the level of international reserves. We look at what is happening globally. You would have known that recently, it was July, there was a bond issue, and so that bumped up the level of our reserves by close to $1 billion. We take that into account, but we also say, listen, this has to be paid for. So we ultimately do look at the long view as to how we operate in the foreign exchange market. We have a situation where we have a flexible and open capital account where we have since 1993 a different exchange rate system, so we're respecting that. And in the circumstances, we know that it could be frustrating. But we listen carefully, we talk very openly to the different actors. But we are in a difficult situation, and we want to make sure that this is put in the context of other reforms.
Hi, good morning, Governor. Aleem Khan Express. I have a number of questions. Sometimes when you read the monetary policy announcement, it seems almost guided by U.S. Policy, monetary policy, and I haven't heard anything about the impact the change in U.S. government might have on the monetary policy going forward. Also, if you can clarify if the Monetary Policy Committee met before the election or after, that might give us some. U.S. election, sorry, yes.
Or if we met after that?
Before or after Trump?
Or if we met in the last 2 days? Exactly. No, we didn't meet in the last 2 days.
Good. So then maybe you could give us an idea of what effect, if any, you expect the change to have. Also, you said you expect 1.5% growth next year. Does that mean we are bottoming out right now? Is this the end of the recession? Next year is 2 months away. The third one, those are two. The third one is the debt to GDP level of 65%. Do you consider that a comfortable level? Thanks.
Well, I will start on the first one. As the governor would have mentioned, we take a number of things into consideration at our monetary policy committee when we make policy actions. One of the things would be, yes, the international interest rate climates. For a while, there was some speculation about a pickup or increase in interest rates in the States, which would obviously have some capital flows implication. Since I think the even money now is that we are closer to an increase in interest rates in the States. Having said that, since the election, markets would have moved a bit, and like most Fed watchers, we're looking maybe from statements from the chairman or the FOMC to kind of get a sense of what is going on that end. But I'm not too sure we could be kind of predictive in our actions or give forward guidance in our action, when by itself it seemed if we would have looked at that for the last year or so, many people would have been unsure exactly what is happening in the U.S. But it's something that we look at. We monitor the movement in markets after the elections. Having said that, there have been some corrections and stuff like that. And at our next monetary policy committee meeting, we would take that into consideration in making a decision going forward. But the governor could follow up and complete it.
Do you want to add anything?
To that?
You wanna?
No, not necessarily to that, yeah.
All right, I guess I can. All right. So you're asking about the U.S. elections. I think there are a couple of factors we need to put in the background. One is that we certainly need to congratulate the U.S. for having free and fair elections and following the democratic process. I mean, it may seem trite, but I've worked in many countries, or several countries, where people died to be able to go to the ballot box. Or when you have elections, they may be rigged, or they may just not happen, or it's a whole mess, right? So that's the first point. The second lesson for us is really the humility that we need to have on predictions. I mean, I think this one to the extreme, actually, in the sense that you have the 2015 UK elections, you had the Brexit, you have this one, and the pollsters, I don't know how they still, in jobs because everything was completely off, right? So that is important even when we take into account, and I guess it's complicated with human nature, but you would think because people have to vote and they may not reveal their preferences, but still you would think that it would not have been so different. And this also gives us pause when we look at other projections of anything else, that listen, we have a projectional thing, but let's be on the safe side. Let's look at the risks of it and maybe take conservative position. The third thing specifically is on the policy direction. It's clear that the markets, based on the polls, based on the consensus of the polls in a certain direction, had not priced in a win in this direction. So you would have initial, uncertainty, but I think this will settle down very quickly. In fact, it has already settled down to some extent. But it will be affecting certain specific sectors, and also the policy direction will need to be sorted out because I think there is unclarity as to what exactly will come out in terms of policy moving forward. For example, sectors that I think would be, wondering what's happening, the health sector, defense, trade issues, and so forth. These sectors would have to really, they may be a bit jittery now because you say, well, what is going to happen? So I think ultimately we would not be able to say what is going to happen. We have a stable democracy in the form of the US. We have strong institutions so that we don't expect that to change. And we just adapt, and as based on what I had said in the discussion, we have to keep in tune with what is happening, look very carefully, not listen to the pollsters too much, but listen to all the information and make our own judgments and to be as responsible as possible to move things forward. So we just wait to see what's going to happen on that front.
It's a growth of 1.6%. I can take that if you want.
Sorry?
She's going to take the growth question if it's button or
If you want. The 1.6%. We projected a growth,
Okay, go ahead.
a level of growth of 1.6%. We did this again. Forecasting projections are difficult, but we're expecting an increase in oil and gas production. New fields are coming into production. We have something else that is going to also maybe growth enhancing, and that's the increase in capital expenditure by the government. That is also will stimulate the economy to a certain extent. And then we have the PSIP, which I mentioned, is estimated to be 5.1 billion, and that is also supposed to be growth enhancing. So these are the kind of things that we look at to be able to predict a growth level of 1.6%. I don't know
Okay.
if anybody else wants to add anything to it.
Okay, let me just go on to the debt question. Now, the level of, one thing you could look at is the level of debt. I think it's more important to look at the sustainability of this, because for every individual, you could indebt yourself a lot, but you borrow because you don't have the resources, and then you invest in something and you're able to pay it off quickly or over time or so. So the important thing is not so much the level of debt, but the sustainability of debt. And if you look at what the institutions do, for example, the IMF, they look at the debt because it's a debt to GDP. It's an indicator, one of the major indicators. But more important is where this debt is going. If a country borrows and it does not invest in productive activity, it has growth that is minimal. It is running up fiscal deficits, continuously, the interest rates are high, then all the dynamics would lead to an explosive debt situation. So this is what you want to avoid, the explosion in debt. So in other words, apart from the number, but the debt dynamics are what are important. I was just looking at the figures for interest rates, and current expenditure, 6% of current expenditure is devoted to interest. And this could grow because depending on what your fiscal path is and how much debt you incur and at what interest rates, then you could find your interest component going up and up. And what would that do? It adds to your debt too because you have to pay that back, and you would have to probably borrow to pay that. But also it takes away from other things that you could be doing. It takes away from the other components of current expenditure, the goods and services that you could buy, the public sector component, etc. As well as on the capital side, it may forestall you having to do capital expenditures. So I think the main point is really looking at the dynamics of the growth of the debt. And the things to look at would be the growth of the economy, the interest rate and how this is moving, and the other factors, including especially how much you are building up debt over time. What is your path for the budget balance? And then what do you use the borrowings for? It is best if you use the borrowings to create the capacity to repay that times over. So you invest in it, you get big returns, and then the debt takes care of itself.
Thank you so much, Governor and staff, for this very important forum. I have 3 short questions. First one, has any thought been given to introducing or reintroducing an element of market determination in the exchange rate? Second, has any thought been given to formally reintroducing foreign exchange controls? Governor, you mentioned in the 1990s we had these removed and we signed on to Article 8 with the IMF, but we know in the last Article 4 report there were some suggestions that we have some issues with that. Are we, or could we formally think about reintroducing foreign exchange controls in an attempt to deal with the imbalance that you outlined so clearly? And finally, my third question, with respect to how foreign exchange is used, Tony mentioned 50% going to consumption. The last trade data available on your website suggests for many years that crude oil was our #1 import. I think because of where prices are, it would have been overtaken by the second biggest import category, which is vehicles and equipment, or transportation equipment and some of the equipment, but basically vehicles and machinery. So those are our 2 biggest import line items. If we want to, as you suggested, Governor, have an adjustment in terms of the way our economy works, how are we dealing with that, where crude oil is our, largely our #1 import? Thank you.
I think everybody looking at me. Market determination of the exchange rate. And, well, linked with the forex controls. Let me ask the second one first. Certainly at the bank, we are not recommending or considering foreign exchange controls. That's as straightforward as you could think. And we keep to the system that we have. But of course, as I said, an imbalance, so how do you deal with that? And so, market determination of the exchange rate, as I said, the rate, in our view, is determined ultimately by demand and supply, so it needs to settle at levels that are realistic. We do have an imbalance now. We do take into account volatility and then the inflows and outflows. But I think market determination, ultimately, any price needs to be reflective of market conditions. So ultimately, this is what would be the answer to that. In terms of the Forex, I wasn't sure, but you said crude oil imports. I mean, the crude oil imports would be used mainly for refining. So I think that would be just, not that we imported it to use here. So to the extent that you don't have local production that is enough of the crude oil for refining, then you supplement it by that, and you have the quality, the value added, and so forth. So I wouldn't pay too much, get too caught up in the crude oil imports. But the other aspect that you talk about would be the vehicles and machinery and so forth. I think, as I noted before, very early in the discussion, that we are accustomed to trading, that we don't produce a lot of items locally, that we export initially the food crops and so forth, that we export energy products or energy itself, and that we use the proceeds of that to import. But certainly, if we have to re-engineer the economy, then we would have to probably have a different base of activity. Now, I don't know if it would mean the more production of all items, but it may have to be other items for export. It may have to be services, more tourism services, whatever kind of services, rather than trying to do everything. So, for example, if we don't have a comparative advantage in the production of cars or vehicles and machinery, there's no point in doing it. It might be better to export something else, get the value from that, and then import that. But of course, it could mean that the type of imports we use would have to be tailored by the amount of resources that we have from the exports. So.
Two questions. The first one is a follow-up from what Alim gave. I thought he was going to push you into the area of anticipating Donald Trump and what he will do and what he won't do. So seeing that you didn't go, let me see if I could push you to go there. He has talked a lot in the campaign about new trade relations for the United States, and he's not alone in that respect. Brexit came before him, and the French are lining up, the right-wing French are lining up in that kind of direction. Do you see some kind of threat to the international trading system as it exists now? And clearly, what is likely to be the impact on countries like ours? And the second question has to do with your green line and red line in terms of the remittances. What are the elements in this red line that has pushed it above the green line?
Anticipating Donald Trump is in the nature of the summary of your question. As I said, we don't know what will happen. I would go back to something that I had said when and this was before the elections. And let me just read it. I don't like to read things too much, but in the IMF outlook, they had said and this was in October, early October. One of the things that they had warned of is that the risk of subdued growth leading to anti-integration policies gaining more traction in the advanced economies. Now, this is a kind of chilling kind of thing. It would be a pity globally if that were to occur, because a lot of progress had been made in moving forward global trade. And if you were to have a rollback of that, it would really not be good for the world economy. But again, it could be reflective of people looking inwards more and just saying, well, let me sort myself out. But again, it comes back to some of the points that I was making when you look at Trinidad and Tobago itself, relative to the rest of the region. And it was really smaller that we have to know that we affect the region. If our economy goes well, it affects the support we could give to them. It affects their ability to export to us. It affects our ability to invest in those countries, etc. If we pursue policies that are counter trade, it affects how they could, their own source of foreign exchange, and then we might have to help them. So it is all interlinked. When you talk about, and this is just, little us, when you talk about large countries, large blocks, the United States, Europe, and so forth, anti-integration policies could really destabilize the whole situation. I remember I had done a paper once and talking about the United States and its bilateral relations, and it was I can't remember the year it was, but it was an IMF working paper. And it was looking at, interestingly, a world where you had global trade talks going on, but there was still a focus on bilateral deals. So that the US was doing a lot of bilateral deals because, for whatever reason, they figured it would get better relations and so forth. And it threatened the whole WTO work. We may be actually getting to a more difficult stage than that, where inward-looking policies, I'm not saying that it will happen under the present, the president-elect, but if it would be sad if we get to a stage where inward-looking policies reduce not only global trade negotiations, but even bilateral trade discussions. So I think I wouldn't want to comment because I don't know what would actually happen, but I'm just saying this is something that we need to be aware of. In terms of Trinidad and Tobago directly, well, if we continue to export, just energy, it probably wouldn't make much of a difference. But if we do re-engineer and get a new world, then global trade issues would be even more immediate for us, because we would be trying to get into different markets. Quantitative restrictions you have to look at. You might have to look at tariff restrictions, non-tariff barriers, and all those sort of things. So I think the general issue, I would generalize the issue and say that it is something that we need to be aware of in terms of the eventual pattern of global trade talks.
Red line, green line.
You answer the question. It's mainly because of China, I think.
Yeah, unfortunately, I don't have the numbers behind the remittances. I know the overall numbers. I do think that it may be because of some remittances to countries like China and so forth that may have increased over the past years, as you have construction projects and as the workers work here, they may spend some here, but they would remit because it's their legitimate earnings. So I think that may be part of it, but I'd have to get back to you because I don't want to say something that is not true on the actual remittance composition in terms of direction. But we could get back to you.
Thank you all first of all, for attending. Thanks for the rich questions, and to the media, I look forward to your coverage. Alim, are you hearing me? Yeah, I look forward to your coverage. Thanks for coming. We will see you certainly for Know Your Money when we come to you as money kind of passes hands, as we all pay for costumes and for carnival fairs. And we want to invite you to that room to refresh yourselves. You must be hungry. Thanks a lot for coming, and God's richest blessings. Thank you.
Yes.